Right now, as we look at the live tape, Nuburu Inc. is trading hands at exactly $0.22. That is 22 cents per share. We are seeing some green on the screen today with a move upward of 0.010, translating to a 4.87% gain for the session so far. When you see a stock trading at 22 cents pop nearly 5%, the immediate instinct for many retail traders is to assume the bottom is in, that the selling pressure has exhausted itself, and that we are looking at the start of a recovery trend. The expectation here is that a company with such specific, high-tech intellectual property in the blue laser space is simply undervalued by a market that doesn't understand the science. However, the reality is significantly more complicated and, frankly, more dangerous for the uninitiated capital. A 5% move on a stock trading at these levels is often just market noise, a fluctuation in liquidity rather than a shift in fundamental value. We need to strip away the optimism and look at the mechanical structure of this price action, because what we are seeing today might not be the reversal you are hoping for, but rather a volatility trap that often catches aggressive buyers off guard. Let us look at the texture of today's trading. The volume behind this 4% move tells a story of its own. In the world of microcap stocks, price action without massive, sustaining volume is suspect. When you're trading stocks like Apple stock or Nvidia stock, you have institutional liquidity providing a floor and a ceiling, creating a somewhat rational discovery of price. With Nuburu at 22 cents, the liquidity is thin. This means that even a small buy order from a retail trader using a Robinhood app or a Fidelity mobile app can jerk the price upward, creating a false sense of momentum. The expectation is that smart money is stepping in to scoop up cheap shares. The reality is likely a lack of sellers at this specific cent interval, creating a vacuum that price drifts up into. We are not seeing the heavy, sustained block buying that characterizes an institutional accumulation phase. If you were using an interactive broker's trading terminal and looking at the Level 2 data, you would likely see a wide bid-ask spread, which is characteristic of a stock that is struggling to find a consistent market-clearing price. This creates a dangerous environment where the fear of missing out, or FOMO, can lure investors into a position that is incredibly difficult to exit without taking a loss if the momentum turns. The broader context of this movement is tied to the speculative nature of the current market environment. We are seeing a rotation where capital is tentatively moving back into high-risk assets, but it is selective. While people are confidently pouring money into Robinhood crypto or looking at established tech leaders, the appetite for cash-burning industrial tech stocks remains low. The move to 22 cents today brings Nuburu slightly away from its absolute lows, but it does not break the macro downtrend that has plagued the chart for months. The technical resistance levels overhead are thick. There are likely bag holders, investors who bought in at 30 cents, 40 cents, or even higher, who are waiting for any liquidity spike to sell into. This creates a phenomenon known as overhead supply. Every time the stock tries to rally, it runs into a wall of sell orders from people looking to get out at break-even or a smaller loss. This suppresses the price and makes sustained rallies incredibly difficult. So while a near 5% gain looks pretty on the percentage leaderboard, it barely puts a dent in the structural damage on the chart. When you compare this to the ease of holding something in Schwab Intelligent Portfolios or a standard Fidelity mutual funds account, the stress-to-reward ratio here is skewed. Active trading in sub-dollar stocks requires a level of vigilance that most people underestimate. You are not just betting on the company, you are betting against the mechanics of the market itself. The stock is currently in a zone where it risks delisting or facing corporate actions like reverse splits to maintain exchange compliance. This is the elephant in the room that the 4% gain today tries to hide. A reverse split is often viewed negatively by the market, as it artificially inflates the share price without adding value, often leading to further selling post-split. The market knows this. The algorithms dominating the Fidelity trading platform and Interactive Brokers platform know this. That is why the buying pressure is often fleeting. The reality is that the stock is fighting for its life on the public markets, and today's green candle is a small breath in a marathon where the runner is already gasping for air. Now let us shift gears to what Nuburu actually does, because this is where the expectation of disruption usually stems from. The company specializes in high-power blue laser technology. The premise is compelling. Standard industrial lasers, which operate in the infrared spectrum, are great for cutting steel, but they are terrible at processing shiny reflective metals like copper, gold, and aluminum. If you try to weld copper with an infrared laser, much of the energy is reflected, leading to inefficiencies and poor weld quality. Nuburu's blue lasers are absorbed much more efficiently by these metals. This is critical because the world is moving toward electrification. Electric vehicles, wind turbines, and consumer electronics all rely heavily on copper. The logical leap investors make, the expectation, is that because the world needs more copper welding for the green energy transition and Nuburu has a better mousetrap for copper welding, the stock must inherently be worth multiples of its current price. They look at the success of Tesla stock and assume any supplier in that ecosystem will ride the same wave. However, the reality of industrial adoption is painfully slow. Convincing a major manufacturer to rip out their existing infrared laser systems, which they have spent millions on, to replace them with a newer, less proven blue laser technology is a massive ask. It's not like downloading a new update for your SoFi investing app. It involves retooling physical production lines, retraining staff, and validating new safety protocols. This sales cycle is long, excruciatingly long. While Nuburu has the technology, the bridge between having a working prototype and achieving mass industrial scale is paved with burnt cash. This is where the disconnect lies. The technology works, but the business model is capital intensive. They need to build the lasers, market them, support them, and continue R&D to stay ahead of competitors who are also eyeing the blue laser space. Competitors like IPG Photonics or Enlight are not sitting still. They have deeper pockets and established relationships. Nuburu is the underdog with the sharper tech in a specific niche, but they are fighting giants with a stick while the giants have bazookas. This brings us to the financials, which are the anchor dragging on the share price. You can't analyze a 22-cent stock without looking at the balance sheet. The reason the stock is down here is not just sentiment, it's math. The cash burn rate, the speed at which the company spends money to keep the lights on, is a critical metric. For a company like this, revenue is often lumpy. They might land a deal one quarter and have nothing the next. Meanwhile, the fixed costs of running a high-tech laser facility remain constant. Investors looking at their Fidelity Wealth Management dashboards or their SoFi active investing accounts are trained to look for growth and stability. Nuburu presents a picture of high potential growth but extreme instability. They have had to raise capital, and in the micro-cap world, raising capital is expensive. It often comes in the form of convertible notes or warrants, which can dilute existing shareholders. When a company issues more shares to raise money, the slice of the pie that you hold becomes smaller. This dilution is the enemy of the long-term holder and is a major reason why the stock struggles to hold gains. It is also vital to discuss the macroeconomic headwinds. We are in an environment where money is not free anymore. Interest rates are higher than they were a few years ago. When rates are near zero, investors are willing to take risks on unprofitable tech companies because there's no yield elsewhere. You might as well bet on the blue laser company. But now, when you can get a decent return in risk-free assets or conservative fidelity ETFs, the hurdle for investing in a speculative stock like BURU is much higher. Institutional investors, the ones who move the market,